Thank you so much for joining us for today's Asia Society Policy Institute Center for China Analysis webinar, What to Expect for China's Economy in 2026. China's annual Central Economic Work Conference, or CEWC, is the country's most important policy setting meeting in economics. It reviews past year's economic performance and, perhaps more importantly, sets a tone, priorities, and boundaries for macro policy in the year ahead. And we know this year's conference comes at a particularly delicate moment. China is entering 2026 with uneven economic recovery, persistently soft domestic demand, still stressed property sector, and mounting structural pressures from local government finance, industrial overcapacity, much debated, to trade frictions. So the language and signals coming out of this year's CEWC matters a lot, not just for China's domestic trajectory, but also for global markets, multinational firms, and the policy watching community looking at China's next moves. And just in the past few days, we've had a couple of high-level signals that kind of really underscore how urgent this moment is. A new Qiushi piece from Xi Jinping himself put expanding domestic demand front and center as a strategic priority, which kind of tells us the leadership is increasingly worried that weak internal demand isn't just a short-term drag, but a deeper structural issue. At the same time, the November data drop yesterday was pretty grim across the board. Retail sales, fixed asset investment, property, none of it looked very good, to be honest. So today we will unpack the CWC readout, what it tells us and what it does not tell us as Beijing looks into its economic policy setting in 2026. I'm delighted to be joined by three outstanding speakers. We have Arthur Kroeber, founding partner and head of research at Gavekal Dragonomics. And we have Michael Hirson, Honorary Fellow here at CCA and head of China research at 2022 V Research. Finally, but certainly not the least, we have Xiangwei Wang, former editor-in-chief of the South China Morning Post and now associate professor of practice at Hong Kong Baptist University. I'm Lizzi C, a fellow on Chinese economy here at the Center for China Analysis, and I'll be moderating today's discussion. To start us off, Arthur, I'd like to do a quick round of initial reactions to the CEWC readout and the related policy signals after the meetings. So, Arthur, starting with you, from your perspective, when you look at this year's CEWC language and priorities, what stood out most, and what didn't you see that we may have been hoping for?
Yeah, well, thank you very much, Lizzie, and it's great to be in such distinguished company today to talk about what's going on in China and what that means for the world. Um, I have to say that my overall assessment is that the Chinese leadership is making something of a rhetorical shift in what they emphasize. Um, but the rhetoric is not really matched by policies. And so overall, my assessment would be that we're going to see, broadly speaking, a continuation of the kind of supply side industrial policy driven growth trajectory as the strategic line of thinking in China. I don't really think that has changed, and there was nothing in any of the recent policy meeting readouts that changed my mind on that. Two things I think do, however, stand out. One is, as you pointed out, there has been a real shift in the language to focus more on the domestic demand issues, that they have identified that as a big problem in a way that they have not before. It was interesting in the Central Economic Work Conference that there had previously, in previous editions of this communique, they had specific references to consumption, and those dropped out, and it was mainly about domestic demand, which I think suggests that they're going to focus less on the kind of consumption gimmicks that they've done in the past, trade-in programs for old appliances and so forth, which frankly weren't that effective, and more on issues relating to maybe the social security system, which has been an important transfer mechanism, and things to boost incomes. And so that's That's okay, I guess, but I think the problem basically is that although they've identified this as a problem, the toolkit that they have available to actually promote domestic
Mm.
demand is somewhat limited. Uh, and the overarching strategic priority to focus on industrial policy to drive technological upgrading, which is what they believe will drive productivity and long-term economic growth, that really has not changed at all.
Fantastic. And Michael, turning to you, how do you read the CWC signal? Do you see more continuity, or are there subtle shifts in tone or emphasis that we should be paying attention to, Michael?
I think my view is quite similar to Arthur's in the sense that we do see this increased rhetorical importance of domestic demand, but when it comes to the actual signaling about the urgency behind these policies and the urgency to boost growth, I thought that the tone from CWC, the language, was significantly less in terms of a degree of urgency compared to last year. Policies should be sustainable. The fiscal and monetary language was less energetic than last year. And the language on stabilizing the property sector, which is probably really the key weakness of the economy right now, was less ambitious in terms of seeking to stabilize the sector than last year. So I think there's a this strategic focus on domestic demand, as you mentioned, is a bit of a double-edged sword. On the one hand, strategic means very important. On the other hand, strategic to me also means long-term, as opposed to really a near-term tool to really boost the economy. So I think that was really for me the main takeaway of the CWC, and I think the recent reduction in U.S.-China tensions doesn't explain all of this, but is a factor for why Beijing may be signaling, reduced urgency in these areas.
Absolutely. Well, thank you so much, Michael, for that detailed read. I mean, as you said, reduction in U.S.-China tension, also, surprisingly good export data coming from October. I think those all boost leadership's confidence. And as you mentioned, in terms of order of priority, risk actually was downgraded from I think number five or number six of to-dos last year to the final item. But we'll talk more about the property later on. But Xiangwei, your turn. You've covered Chinese leadership's thinking, policy signaling for decades. From your standpoint, how should we interpret the messaging coming out of this year's conference?
Thank you, Lizzie, for having me. I think to me, the the thing that struck me the most was the tone of the communique released following the conference, which is it seemed to me the leaders are quite content. I think if you compared the communique from last year's conference and this year's. I think last year was very urgent, and they have all the words that showing urgency, sort of wanted to stabilize the property markets, the stock markets. From this year's statements after the conference ended. So, the the thing, as I have said earlier, sort of struck me the most was content. And although uh, she did, as Arthur and Michael mentioned, the strategic importance of consumption and following the conference, the Chosen magazine also released a collection of Xi Jinping's remarks on the importance of consumption. But I totally agree with what Arthur and Michael said. It's sort of rhetorical shift. But there is one thing I think worth mentioning, which is that uh, again at this year's conference, Xi Jinping, I mean, the communique mentioned about the importance of investing in human capital. Uh, as the state media in China reported, for the first time, Premier Li Qiang, in his annual government work report, I think in March, for the first time, they wrote this investing human capital in the government reports. And I did a bit of research, and it seemed to me that the Xi Jinping first mentions about investing in human capital back in 2015. And then in 2023, the phrase was mentioned again. And this year, now the state media has started to talk more about investing in human capital. What it really means, the conference, those leaders sort of did not explain very clearly. But I think it's more in line with the emphasis on consumption. When we talk about investing in human capital, 投资于人, which means it's not only about talents, it's also about investing in well-being, improving the living standards of the people. But exactly how are they going to do it? We still haven't seen much concrete measures. I mean, it's all rhetorical. It's all about signaling that they want to boost domestic consumption, but exactly how, we still have to wait and see. That's my main takeaway.
Fantastic, Xiangwei. And we will talk more about domestic demand later on. But before we dive into specific policy areas, I'd like to ask each of you to kind of briefly zoom out in 1 minute each, perhaps. What's your baseline outlook for China's economy in 2026? We're not looking for a specific forecast in numbers. I won't hold you to that, but maybe a characterization. Are we going to see stabilization? Is China going to muddle through this year in terms of fiscal policy? Are we going to see renewed momentum, something new? Arthur, let's go in the same order.
Yeah, my outlook is very boring. It's basically more of the same. So not that much change in the overall growth profile, not that much change in the overall deflation profile. We've had the price level falling by about 1% a year for the last couple of years. I think that continues. Pretty good export picture. I think that clearly the biggest variable is on the export side because that involves factors that are essentially outside the control of the Chinese government. How much does global demand hold up, and do you get some more effective protectionist pressure that comes to bear on China? And then I have some thoughts about the whole excess competition issue, but that's less policy related, so maybe we can deal with that later.
Awesome. And Michael.
Once again, maybe refreshingly but boringly, agree with Arthur. I think at least for the first half of the year, it seems like we're in a muddle through approach, given pretty strong headwinds for the domestic economy, property, weak labor market, kind of fragile confidence overall, and just not a lot of counter-cyclical policy. So I think stability at low levels. Maybe in the second half of the year, it may be more interesting in terms of whether we get another sort of so-called policy pivot. The 2027 leadership transition may increasingly come into view as we get towards 2027, but I think that's the outlook for next year.
Fantastic. And Xiangwei, please.
I think both Arthur and Michael have taken words out of my mouth. I mean, I think this year, as I mentioned in my first 2 minutes, I think this, the leadership, at least from the statements, they're very content with the direction and the trajectory, they have plotted. And I think in terms of economic growth, they probably will continue to aim for 5%. I mean, more or less, and I think, given the dismal November numbers, I think there were people talking about whether they will launch some mini stimulus package. We don't know. To me, for China to boost domestic consumption, the easiest way, the most effective way is to stimulate the property market. But it seems to me the leadership is not going to do that.
Right. Well, thank you so much. And well, we have three panelists broadly in agreement, but we welcome our audience, live audience, to challenge our panelists. We will get to the Q&A section at the very end of the webinar. So if you have thoughts, if you want to challenge a specific point our panelists raise, please do just drop us a line of question or insights or feedback in the Q&A session. We will make sure to get to them at the end of the session. So let's talk about the core constraint. Xi flagged in this Chu piece, and all three of you mentioned domestic demand, especially the unresolved drag from property, which is getting pretty critical at this point. Arthur, there's a lot of emphasis on supporting domestic demand, as you mentioned, from the policy signaling, but large-scale consumption stimulus seems off the table. So, from the policy toolkit perspective you mentioned, what levers does Beijing actually have left that could move the needle in 2026? Shall we be more pragmatic here?
Yeah. So I think one thing, since we all seem to agree on everything, it might be interesting to see if we can open up some speculative territory here where we can make stuff up and maybe have a wider spectrum thing. And I guess the thing that I find perplexing, I agree with Xiangwei that if you read the documents, the implication pretty clearly is that the government is more or less satisfied with how things are going. Michael, absolutely correct to note that if you compare this year's document to last year's document, it is more relaxed. Our estimate, my team's estimate of how much support from the fiscal accounts we can get next year. This year, we estimate is around 2.5% of GDP in terms of fiscal stimulus. Next year, we're looking at something more like 1% of GDP. Based on the various readouts that we've gotten. Again, you look at the property sector, what's striking is the first half of this year, the property sector seemed like maybe it was stabilizing a little bit. So it's like, oh, okay, things are in there. And then it got worse in the second half of the year. And the government is now saying, oh, it got worse. That's fine. We don't really have to do anything to support that. I find this all a little bit perplexing. So I think one question that we all want to grapple with here is, why are they so comfortable with the state of affairs when it is so obviously unsatisfactory from the standpoint of aggregate demand and vitality, right? And I don't know that I have a tremendous answer to that, but I think kind of trying to understand what is going on in their thinking is an important task here. In terms of just the toolkit, so if you look at the property sector, basically the main tool that they introduced was this program to encourage local governments to buy up unsold properties, convert them into the affordable housing, take them off the market. And basically what the local governments have been willing to do to some degree is take the financing that's available for this kind of activity and buy up land, but they've not really been very interested in buying a property, developed property, which makes sense because land is an asset that they can continue, that they can recycle later, maybe. You buy up unsold housing. What do you do with it? Yeah, the central government can say, well, you should turn it into affordable housing, but that's easier said than done. The incentive structure really is not there. So I think that the toolkit on property is very clear that you would just much more aggressively promote these efforts to remove excess capacity from the market and frankly do anything with it. You could turn it into affordable housing, you could tear it down, you could just stop this inventory overhang and do kind of a reset of the market, and then have a more constructive approach, more supportive approach to property investment or speculation, but they don't want to do that, right? If you look at the consumption side, my sort of master view, and I'll just give you a very big overview here, and then maybe Xiangwei and Michael can fill in some of the details. My general view on this is that they've spent 40 years building up a investment machine that works extremely well for creating sustained long-term investments in a wide range of strategic sectors. They've created ecosystems of manufacturing competitiveness that are very, very impressive. And every piece of economic management over the last 40 years has essentially been focused on building the investment machine. They've done nothing comparable on the consumption side. So we can talk about things that they can do around the edges in terms of like putting more money into this or that social security program, fiddling a little bit with the hukou or the residence permit restrictions so there's more labor mobility, et cetera. And I think that's a lot of the stuff that's on the table, and that's fine. But the reality is, if you want to make a significant shift out of this disinflationary weak demand environment, what you have to do is, number one, in the short term, address the confidence problems, which are the terrible property market, and the fact that this is the weakest job market probably in the last 30 years or even longer in China. So households don't have confidence because their asset, which is their housing, is going down in value, and their employment and income prospects are slowing continuously. So you need things that reshape that. And then on a more strategic level, you would need to do pretty significant shifts to the fiscal system, the financial system, to change the incentives of local governments to focus on promotion of service and consumption activity as opposed to promotion of investment. And what's striking is they're talking a little bit about that first bucket of things, and they're not really talking at all about the second bucket of things.
Mm-hmm. Fantastic. And Michael, I want to stay with demand and the property issue a little bit. Beijing has relied on a series of incremental fixes, right? Easing mortgage, lowering down payments, encouraging local government to absorb inventory, as Arthur pointed out. From a macro standpoint, it doesn't seem to be enough to stop property from continuing to be a structural drag in 2026. So why isn't China doing more? And what are the available tools on the table that China can potentially use, perhaps later next year, if things turn for worse?
I think that's a good way of putting it. I think my colleague at 22V, our China economist, Hozi Song, I think has a very good way of framing this, which is that property has gone from being a cause of China's macroeconomic weakness to now being a symptom. In other words, it's really, to get to Arthur's point, it's the lack of household confidence, including confidence in their income outlook because of the weak job market. That's one of the key features holding back property. Also, deflation. Because of deflation, real rates for mortgages really have not come down very much. So I think this basically points to, if leadership really wanted to stabilize property, two things would be necessary. One would be, as Arthur said, really using the central government's balance sheet to address this overhang of inventory because it's not working left to local governments. And then two is really stronger, just macroeconomic stimulus to boost confidence. And that would probably be fiscal policy, especially, but arguably also perhaps more room for monetary policy, given that real rates still remain high for household mortgages.
Fantastic. Another potential candidate tools I've been hearing about is centralized stabilization fund. So this idea of 平准基金, which should be a no-brainer. I mean, 10 years bound rate is so low, and rental return is actually higher than 10-year bound rate. So there's no reason that this will not be a high return investment. But we'll see what will happen. And Xiangwei, going back to you, this buzzword you flagged, investment in people, 投资于人. Notably, it's still framed as investment. Why does the leadership continue to shy away from more direct support to the households? What's the thinking behind that?
Thank you. Thank you for that. That question is a great question. You see, I just want to follow up on what Arthur and Michael said. You have, for you to understand why China has been so reluctant to boost consumption, you have to understand, the management philosophy of China's leaders. I mean, ever since the reform and opening up in the late 70s, you see, ever since China's opening up, China has, over the past 40 years, China has always relied on these two traditional growth engines, infrastructure and investments. infrastructure investments and exports. And those two growth engines have served China so well. And, like, I mean, even though over the past 20 years, the China's leaders have talked about boosting domestic consumption, but they have been relying on this for so long, so well. It's very difficult for them to win themselves off those two growth engines. Like last year, China's trade surplus registered more than 1 trillion US dollars in the whole year. And then China got that number in the first 11 months. And that's the first point. The second point is because China has been relied on these two engines for so long, so the officials, particularly those officials who work for the NDRC, the National Development Reform Commission, the economic planners, they have been trained, the generations of officials have been trained on this. So that's what they know. And so if you ask them for plan to boost domestic consumption, the best they can come up with is the upgrades of electrical appliances for home or the EVs. They have been not trained or they have little experience on boosting the domestic uh, uh, consumption. That's why uh, my view is I'm very sort of pessimistic on this. My view is so long as China can still can still get traction from those two growth engines, China will not take serious measures to boost domestic consumption. And the second, one last point I want to make is in relation to the property market is that, ever since Xi Jinping said the housing is for living, not for speculation. I mean, it had completely changed how the people in China view the property, the kind of the now people no longer see property as a kind of investment anymore. I mean, if you take that out of the equation, and then it's going to be very difficult for China to do anything to put the property market on a healthier track. And the last thing I would mention is this, there is a cynical view among sort of lots of analysts and property developers in China is that, right now, the sort of the sluggish property market, residential, has given uh, the uh, the governments and the state-owned enterprises a great opportunity to buy those lands and properties
Yeah.
at like a fraction of their prices. In Chinese we call it 割韭菜. Right now is a great time for them to do that.
Yeah, fantastic. And really insightful, especially the institutional muscle memory point you made, which I think is a critical part of the conversation. How much local bureaucrats can actually do, how much they know how to do, and what's their capability. But let's shift to anti-evolution, which has become a much more explicit part of the official rhetoric this time around. Arthur, I want to start with you. From an economic perspective, help us understand how serious is this evolutionary price war problem and also the related deflation problem right now, as you mentioned. Anecdotally, it seems the Chinese leadership doesn't view low price or deflationary pressure per se as a major issue. The word you hear is, well, why is low price not a good thing? Things are cheaper, more affordable.
Yeah.
Why is it not a good thing? So help us unpack the economic dynamics and the logic and the implications of that.
Yeah, so there may be people on the call who are not familiar with this term involution, which is a strange word translated from a kind of obscure Chinese term. Um, so one way of thinking about involution is that it's just another way of saying what we would call excess capacity. There's too much supply, not enough demand, and so you get these kind of price war competitions. So the cynical view on involution is that, you know, when China came under attack from the rest of the world for having excess capacity, they never wanted to admit that. And so they came up with this other word, which is technically something else, but really the same thing. I think the kind of the deeper way to understand involution is this is a permanent sort of or persistent feature of the Chinese political economy. And basically the way that it works is, and we've seen this, you know, time and time and time over again over decades, central government will put out some notices saying X, Y, and Z sectors are really important. They're strategic. We should do them. And then what happens because of the kind of decentralized structure of China, every local government gets in the act of investing in this favored sector because that's what the central government has indicated will be favored. It's easy to get bank loans to start this stuff up. And increasingly, as the private capital markets have become more important in China over the last decade, investors in the capital markets also rush in to support these new favored sectors. You get this enormous explosion of capacity in the favored sectors. And then what would happen in a market economy is a lot of the less competitive companies, they would just go out of business right away. But in China, they don't, because local governments have tons of ways off budget to support their local enterprises. They can give them cheap land. They can lean on the local electricity generator to give them cheaper electricity prices. They can give them all kinds of soft benefits that don't really cost them anything. And in return, what they get from that is employment at these, you know, production facilities, and number two, production taxes when the stuff is produced and goes out the door. And so there are enormous baked-in incentives throughout the system to keep excess capacity in the system for way, way longer than would be possible in a fully marketized economy. And so what that means is that you have these very protracted periods of excessive capacity, and then the players, the individual players, what's their incentive? Well, they know that there are too many players and that at some point in the future, there's going to be a cull. How do you be sure that you're the winner? You are the biggest. How do you get to be the biggest? Well, you cut your prices so you can pick up market share. And so it is a cycle that feeds on itself. And we've seen this in sort of individualized sectors repeatedly over the years. What's different, I think, this time is there is so much of the manufacturing economy that has been engulfed by this. It is not this sector, that sector, it's almost every sector. And why is that? I think the simplest explanation is if you look what happened to bank credit to the industrial sector. In 2019, bank loans to industry were about 500 billion renminbi. In 2023, 4 years later, they were 3 trillion. So there was a six-fold increase in the provision of credit to the industrial sector, which went to a wide range of places, a wide range of sectors. And then once you've built up all of this capacity and all of these producers, it's very difficult to cause them to go out of business. So what I would say is that's the problem. It's like a feature of the Chinese system. It's not just sort of some kind of cyclical anomaly. The government has said, yeah, we don't like this, you know, it must stop, right? And I think Xiangwei will be able to testify from his many decades of looking at this. I mean, how many times have we heard NDRC say, there's too much capacity in Industry X, it must stop. And, you know, 2 years later, there's twice as much as there was before. So, you know, they've said they don't like this. What are they going to do about it? It's not very clear. What I think is interesting to watch this year is we've seen a significant reduction, a halving of bank credit to industry over the last couple of years. We follow various measures that try to proxy capex, and there seems to be a significant pullback in manufacturing capex over the last couple of years. So we may be getting to a point where essentially the ability of the system to finance all this excess capacity has kind of hit its limits. And we may start to see some consolidation, but it's going to be, I think, a tough slog.
Well, thank you so much, Arthur. And I think you just nailed on just nailed it. I think there are some thinking, especially on the financial side, not just adjustment to bank credit, but also potential tax rebate changes. Actually, we just saw this rollback of tax rebate to some of the sectors. But how that will play out, I think that's definitely a watch point. But Xiangwei, let me take you on here. What do you expect? What concern is China really trying to address? Why is anti-evolution such a prominent political theme now? And do you expect Beijing to just, let the market shake it out, with regard to excess capacity? Is there going to be more forceful intervention, whether it's industry consolidation, changes in pricing rules, changes in bank credit system, as Arthur highlighted? Where do you come out?
Thank you. It's a great question. From where I sit, I believe it is very difficult for China to reduce this evolution style and healthy competition. I think this is sort of because, if you look at China, we see China as a very authoritarian, top-down sort of governance model. But in fact, China has 33 provinces and municipalities. I mean, even with now Xi Jinping as the most powerful leader in China right now, I think the party secretary of every province and municipality still has a great leeway in terms of industrial and economic makeup of their province. I mean, there are so many examples, I mean, so, in the past, in the initial years of China's opening up, every province set up its own assembly plants to assemble vans or refrigerators and air conditioners. And then later on, there was a glut, oversupply of air conditioners, and then the government would take measures to consolidate. So I mean, that's why I think it's very important that now Xi Jinping is pushing for the so-called unified national markets. I think right now, China has this big national market. Inside the national market, we have like 30 different smaller markets which are protected by the local measures. I mean, the local sort of protectionism is very strong in the sense of what Arthur mentioned, like, they will use the soft measures like tax rebates, as you have mentioned, and other measures to support the local enterprises, for the purpose of job creations. So I think I think China's top leaders realize that problem, but it's so difficult to do it is because, that involves a much bigger reform in taxation, in revenue sharing. I mean, that part, I don't think the government, how do you share the revenues between the central government and local authorities? I mean, that part has not been, the kind of taxation reform have been talked for so long, but it has not been really has been much progress. Of course, they transfer the money from the central government to local authorities, but sort of then again, the local authorities, the officials, they are responsible for job creations. And so sometimes, this overcapacity, will be there for a long, long time. And the government is realizing this, and there's also this involution style competitions is unhealthy on the domestic front, and is now with exports surging in almost every sector from China to the rest of the world. Now, China is effectively exporting this involution style competition to the rest of the world. So I think, but then again, I find it very difficult for government to curb that unless they undertake some serious reforms.
Yeah. Well, thank you so much, Xiangwei, for that perspective. Michael, I do want to push you for a prediction here, if you don't mind. I mean, on one hand, China's industrial export machine is going strong, and export actually, carried a lot of weight for China's economic performance this year. But if domestic absorption stays weak, this evolutionary price war thing continues, I think even more trade friction is almost inevitable in 2026 and beyond. And we're probably going to see more tensions, more supply chain fragmentation, more de-risking, from China. Um, from Beijing's perspective, is there appetite to recalibrate its external trade relations, if for nothing else, to make sure its growth engine can still chum along in 2026, which has its domestic economy, has been as discussed, has a host of other issues? Or does the leadership, despite the rhetoric on rebalancing, still believe it can absorb the trade tensions? What's your prediction on the trade front when it comes to evolutionary prices and external spillovers?
I guess to me, it just seems like, this is a slow moving ship. I mean, Arthur and Xiangwei, I think, put it very well in terms of explaining the inertia in the system. And, the leadership, I think, needs to be proven wrong that China can't continue this before it really undertakes, a major shift in the growth model. So they did not get that disconfirming proof this year. China's exports, performed fairly well. I do think, as you said, Lizzie, it's unsustainable. It's becoming politically unsustainable, and perhaps economically unsustainable as well. Even with all these exports, domestic industry is in a difficult spot. Um, but I don't think we're there yet. So I think at least for next year, to me, the outlook seems more of the same, including more pushback on this issue, continued excess capacity, continued deflationary, or China acting as a deflationary or disinflationary force for the rest of the world. More concern about the so-called China shock or the next phase of the China shock coming for foreign manufacturers, increasingly in advanced sectors of the economy. I think all of this continues next year.
I see. So roughly the same year, continuity seems to be the theme, from your all three of your insights. But I do want to push you all a little bit on surprises. Perhaps
Mhm.
one person, well, 1 minute each person. Arthur, where do you see the biggest upside policy risk? Areas where Beijing could potentially do more than what we expect today and meaningfully change its economic outlook? And relatedly, what's the most underappreciated downside risk for 2026, starting from Arthur, then we'll go to Michael and Xiangwei.
Yeah, I guess I would not focus on policy surprises because we're only going to get policy surprises if something else surprises them and then they are forced to pivot, right? So what could change? Well, okay, so one thing I think that will be interesting to watch is you look at, just picking up the last conversation, you look at the pressures in some of these industries, they've gone really intense. Um, and we have actually seen some significant changes in pricing. So a couple of the areas that the government has targeted um, for anti-involution are polysilicon, the precursor for solar panel production, and batteries. And you've seen the prices of these things go up quite a bit recently. So I think one thing we want to watch out for is maybe you get a more rapid pace of consolidation and downsizing of capacity in some industries than we anticipate. Um, and that will be a mixed blessing because if you have a lot of closures, you'll have loss of employment, and that actually could be bad for economic growth, right? So I think one thing to look for is, let's suppose that consolidation goes faster than anticipated and creates more downward pressure in the job market and in local government finances, what does the central government do about that? Right, to be one question. And none of these are, I think this is going to happen. These are risks that you're looking at sort of out of the side view mirror. That'd be one. Number two, what happens if you just have even more catastrophic declines in the property market than you've had so far? And the central government wakes up and says, actually, this is a bigger problem. Our sort of whatever approach, which is in this year's Central Economic Work Conference document, maybe the problem gets so bad that they have to jump in and do something about that. So that, I think, would be my risk number two. And then risk number three, and this is really far down the list, is let's say that the rest of the world finally gets its act together and say, you know what, this is exporting of subsidized production is no longer okay, and you get a more significant set of protectionist actions out of the rest of the world to try and limit the flow of Chinese exports, or you simply have a downturn in global demand, and so the export channel becomes much less viable for these companies that are producing too much. And that perhaps feeds back into the first risk that I said, that maybe the financial pressures get too weak. So basically, I think what I'm saying is that there are a bunch of downside risks in the economy that could make the actual economic numbers much worse by, say, the second quarter of next year. And then how does the government respond to that? That is, I think, basically what we need to be concerned about. I think you wanted us to think about an upside risk. I'll take a pass on that for the moment. See if you can come back a second time, if I can think of anything on the upside.
Yeah, sure.
I can't at the moment.
Sure, absolutely. And Michael?
I think that my response basically was going to be a little similar, unfortunately, which is basically, do we get another policy pivot? We had one in September of last year as the pressures really started to mount in terms of deflation, but even more so local government finances. And I think it is possible that we could get another one, possibly even a bigger one, later this year. Now, that, as Arthur said, would probably be in reaction to worsening economic indicators and conditions and social conditions. But again, we are starting to get closer to a leadership transition. It is possible that that could force the leadership into a stronger pro-growth orientation. One sign of this would be, for example, a diminished emphasis on high quality development, maybe some loosened constraints, for example, on local government borrowing. A sign that the leadership is really inclined to finally try to reflate the economy. But I don't think we should consider this base case. That's why I would put it in the form of an upside case, or maybe just a surprise, not upside, because again, it would be in reaction quite likely to negative news.
And finally, Xiangwei.
Uh, I I wrote a commentary a couple of months ago, just talking about what China should do to resolve these trade tensions with the rest of the world. Is that China became the second largest economy and also the largest trading power, the largest exporter in 2010 or 2012. And I think the next target China should do is to become the world's largest importer. I think that has many benefits. First of all, it's going to reduce trade tensions not only with the US, but with EU and all the major trading partners. And secondly, it's going to greatly help stimulate domestic consumption. Let me just give you one or two examples. China now is working very hard to develop the so-called the silver-haired economy, to boost the services for the elderly care. But China is not very good in doing this. I think in US, in many other countries, they have sort of better quality services and managements in this area. And, you know, this is just one example. There were so many examples that China can do to increase imports. And this can be also a way to boost domestic consumption. You know, in China, in terms of domestic consumption, there were two things. One thing is that right now, because of lack of confidence, because of the property market, the people are not spending. They're not spending, and then for others, they are not spending is because, you know, they want better, high quality services, which are not abundantly available. The second point I want to make is I think the Chinese officials, especially those formal officials, you know, those officials were in charge of economy, when they were in power, they followed the government lines, right? After they have retired, you know, they started to make those rational, sensible suggestions now. You know, one thing recently, one line many of them have talked about is how urging the central government to inject more state-owned equity capital into the pension fund. I think this is something that China should do more. I think the last time China did it was in 2017 when they injected some trillions of yuan into the pension fund. I think China should do more. I think in terms of I think the figures which came out last year was talking about the state equity capital is around 140 trillion yuan. I mean, even if the government inject 10% of that, it can greatly boost the pension fund and also boost the domestic confidence. I mean, if you talk about what China should do, I think that's something that China should seriously consider if China really wants to pivot to domestic consumption.
Really interesting insights from all three of you. Finally, I want to turn to external environment, especially China's relationship with the United States, which, I think you all flagged as kind of the real volatilities, if you will, for China's growth trajectory next year. So what's the relative balance of power between China and the United States from Beijing's point of view? I mean, there's renewed talk of the world shaped by two superpowers, right? The return to G2 framing, believe it or not. And from Beijing's point of view, I mean, there are reasons for confidence, right? Leverage seems to be shifting in trade negotiations with China's rare earth trump card, real breakthrough in China's tech sector, which reduces chokeholds from U.S. export controls on China's development trajectory. But at the same time, I mean, if you look at the Politburo's meeting and the Economic Work Conference assessment of international environment, it still seems pretty grim, right? This idea of the world is undergoing profound change. New developments have had an increasingly direct impact on China's domestic trajectory, hard to predict risks. The task of achieving growth and security more complex than ever. So the language is still pretty grim. How is Beijing really assessing the U.S.-China balance of power, its external environment? And how or where will those strategic assessments show up in concrete policy choices? I'm going to start with Michael and then to Arthur and then Xiangwei.
Great question. I think that Beijing does have reasons for confidence. I think the two advantages in terms of how China, probably the leadership, thinks about competition with the US is basically confidence in China's system, especially political system, the ability of the party to coordinate across all parts of Chinese society, to maintain unity, to channel resources, to, very importantly, to guard against special interests hijacking policy. And then also really trying to strengthen manufacturing. That the U.S. is an over financialized economy and is not able to achieve the real economy outputs, especially in critical supply chains like rare earths that China has. So I think that's very important. At the same time, leadership recognizes vulnerabilities. It's not there yet in terms of critical technologies, still too reliant on the US and allies, especially in semiconductors, but not limited to semiconductors. That's a key one. And then on the military side, it's still, I think Beijing certainly not satisfied with its relative military power compared to the US, and then also concerns that she has about loyalty and competence within the military. So, what does it translate to in terms of policy? I think Beijing is very happy to take this window of stability that I think she has very masterfully accomplished with Trump, driven by Trump's political concerns, but is under no illusion that this is, a lasting U.S.-China truce necessarily. So, use this period of time to try to continue um, a period of low tension, at least for another year, while trying to make progress in beefing up all these strengths and reducing all these vulnerabilities that I mentioned earlier. So I think really what happens next year will come down essentially to Trump's political calculation. And thus far, he seems to think that keeping things even with China, keeping China buying soybeans and having things on an even keel is important for him and his, outlook for the U.S. midterm elections up through November of next year.
Fantastic. Thank you so much. And Arthur, how does Beijing see its balance of power vis-a-vis the United States?
Yeah, basically I agree with Michael on that. I think short term we've got this kind of truce situation, which, as Michael said, is driven on the U.S. side by Trump's need for smooth sailing into the midterms. And long term, you still got this strategic rivalry. I mean, the way I would describe it, if you look at the overall balance, is the U.S. still has overall the stronger hand, more dynamic, larger economy, a wider range of technological competences than China. But the U.S. has a strong hand that it's playing not so well, and China has a weaker hand that it's playing very, very skillfully, frankly. And that's partly because China's strategic objectives are more limited. The US has to think about the entire global system and has commitments all over the world. China basically just has to stick to its knitting, increase its own capacities and its force projection capabilities within its own region, so they can concentrate their resources on a narrow range of strategic tasks. So that is the overall picture to me. And actually, this gets me back to, I did think of an upside thing for next year. To me, the question is, how creative do Xi and Trump get in using this year of stability that they seem both determined to have? And I think there's an interesting opportunity here. And I would put this at like somewhere between a 10 and 20% possibility. But Trump has talked at various times about, wouldn't it be great if Chinese companies came to the U.S. and started building stuff there and employing U.S. workers and so forth? And that is very different than a lot of the rhetoric you hear in Washington, which is that all Chinese investment is like, the beginning of the fifth column and, the end of the republic and whatnot. So if Trump really wanted to get inventive and aggressive, and the Chinese really wanted to push this, you could imagine a situation where we go into this meeting in April where Trump is supposedly going to Beijing, and they come up with a mechanism for increasing Chinese investment in certain technology sectors. Batteries would be an obvious one, maybe some other kinds of clean tech in the United States. Politically, this would be a challenge, but if there's anyone in the U.S. system who can override the national security concerns about this and say, no, this is just good for business, it's Trump, right? He has that unique ability. I think that the Chinese have indicated that they want that. They want a better investment in climate for their companies in the United States. It would help a lot for the competitiveness of their firms if they could get better access to the world's biggest and richest market. So there are, and frankly, I think you can make a case for what would be good for the U.S. economy to have certain kinds of Chinese investments, particularly in technology sectors where Chinese companies are very good. So there is a deal to be done there. And if that were to happen, that would be, I think, a significant upside surprise for China, because it would be a signal that the overall sort of long-term projection of geopolitical risk has gone down quite a lot. And the specific business opportunities for some of their leading firms have gone up quite a lot. Uh, and it is, I think, not likely, but it is definitely doable. So to me, that's kind of the interesting space to watch over the next year. But I agree with Michael. You have sort of like there's this year, which is probably going to be fine, and then there's what happens after that, which is who knows.
Fantastic. Thank you so much, Arthur. And Xiangwei, I'm gonna give you the last word on this. How settled is Xi's view on the United States and also on the Trump administration? I think that's tremendously interesting. And is the Beijing leadership locked into this strategic rivalry framing, or do they see President Trump's second administration as a real opening for doing more pragmatic deals?
Yeah, I think I just it's a great question. I think right now among certain people in China, they're talking about a Trump's window of opportunities for China. I mean, there are things, I'm sure a kind of deal is more likely to be struck between China and the US when Trump comes to visit China in April, as he said. Uh, on the overall trajectory of China-US relationship, I just want to offer this perspective, my perspective on this. Back in 2019, 1 year after Trump launched the first trade war against China, I was invited to speak at a investors conference in Hong Kong, and I was asked to give my 2 cents on the future trajectory of China-US relationship. And I came up with this phrase in Chinese, and it's very difficult to translate in English. So I'll say it in Mandarin first, and then I'll do a literary translation. So my 2 cents is that the future trajectory of Chinese-US relationship will be characterized in these 8 words in Mandarin: 打打谈谈谈谈打打, which roughly means fight, fight, talk, 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 fight, fight. So right now we're in the phase of talking and making deals. And then, who knows, maybe, 1 year later, we are back to the fighting again. I think this is the kind of trajectory that, will be like this in the coming years.
Fantastic. And what a phenomenal framing of the relationship between United States and China. We have some journalists in the audience. Maybe they can help us come up with a better translation or a more elegant translation of the dynamics, which I think is very much on point. So thank you all. I mean, that was a terrific discussion. We're now opening things up for audience questions where they have a few very interesting questions, but please do submit your questions through the Q&A function. I will do my best to group them thematically. We have a question on Taiwan from our audience. Do you see economic headwinds as making a China move against Taiwan less likely or more likely? Uh, will the Chinese leadership want to change their population's focus from the domestic economy by going for it with Taiwan? Anyone want to take the audience up on that front? I'm gonna go with Arthur.
I was going to volunteer Xiangwei to pick that one up.
Sure, Xiangwei, do you wanna?
Are you okay with that, Xiangwei? Because you spent more time looking at the politics than we have, but I'm happy to address it. But I think it might be better.
Yeah, I'll go first, and then Arthur can give his views. I think Trump said a couple of times that Xi Jinping, he got this assurance from Xi Jinping that China will not make any move against Taiwan militarily when Trump is the president. I mean, even though the Chinese side have never acknowledged that remark, but I think that in China there are certain nationalists who are under this illusion that this Trump's window of opportunities could afford China to do a deal with the United States, so the U.S. Would somehow uh, allow Beijing to accelerate what we call the reunification, the great cause of the reunification. Um, I seriously doubt that. I think there has been so much speculation. Some people even mentioned about the timetable 2027, the earliest, or 2030 or 2035. I think those are the sort of wild speculation. I don't think uh, 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 you know lots of people are talking about China has already has a timeline. I don't think that's the case. I mean, I think the I think with Trump as the president of the United States, if you see the recent sort of developments over Taiwan, particularly in relation to Japan, I think there is a opportunity for China and US to do something over Taiwan. And the as I mean, no matter how you look at it, the Taiwan issue cannot be resolved by the Taiwanese themselves. The Taiwan issue cannot be resolved by China alone. The Taiwan issue is always an issue between China and the United States.
Mm, fantastic. Arthur, do you want to add to Xiangwei's answer?
Um, no, I think that's a pretty good description. I guess one sort of thing I would put on top of that is there's been a lot of commentary recently about the national security strategy that Trump released last week, which is frankly a very confusing document. And I suspect it's more of a sort of rhetorical statement of attitudes than a actual prescription for what they're going to do. But one thing that's noticeable is I think Trump actually has succeeded in reviving strategic ambiguity as the U.S. posture towards China, not because he embraced that concept, specifically, but because if you read the parts of the document about the Indo-Pacific in the context of the whole thing, it's very confusing, right? Because on the one hand, he's saying, the U.S. spends too much time operating, far from its shores. We should not try to run an empire. We should not try to be hegemonic. However, in the Indo-Pacific specifically, we must maintain and increase our military force posture to prevent any kind of military action over Taiwan, and we can't allow, a unspecified adversary in the Indo-Pacific to, ability to do what it wants. So on the one hand, you have that. On the other hand, you have this situation where recently the Japanese Prime Minister made some, tactless comments in the Diet about Japan's view on Taiwan. The Chinese, reacted very strongly, and Trump really has not been backing up the Japanese on this in any way. So, is he for an accommodation over Taiwan, or is he for pushing China back? Actually, it's not very clear, right? And I think that reflects a little bit more confusion on Trump's part than a deliberate strategy. But nonetheless, I think we are back to strategic ambiguity, which frankly, to Xiangwei's point that the U.S. posture on this is really important, I think that is a stabilizing factor. If the U.S. maintains that posture, maybe we will get more aggressive, maybe we won't. I think that puts certain constraints on what the Chinese might want to do and maybe on their timetable.
All right. Well, thank you so much, Arthur, for the insightful answer. And Michael, I'm going to turn to you. We have a question on AI. How will the AI raise shape China's policy thinking and shape China's economic trajectory? Will China fully back AI initiatives as a new engine of growth, like it has been in the United States? And how does AI play into China's economic picture?
Great question, and one that you, Lizzie, have done a lot of really thoughtful analysis on. I think China's leadership is very enthusiastic about AI. It's very important to note that it's got a different dynamic than in the US. I think it's very much more about AI applications and especially AI's integration into China's manufacturing sector and broader economy, as opposed to this race for AGI, artificial general intelligence, and much less enthusiastic about that kind of speculative aspect that we see very much now in the US. In terms of an engine of growth, I think you could make a case. I mean, it depends on how you think about AI in general, that it could, have a significant impact in terms of China's productivity. I would say one point to watch, and very much germane to our earlier discussion, is AI does seem to be having a negative impact on the job market right now in China and hitting particularly hard in one of the softest parts of the job market, which is demand for recent college graduates. China's policymakers thus far seem to not be really concerned about this. They're much more focused on not standing in the way of a very important technology. But I think this is going to be a very interesting theme to watch. You see the politics of AI heating up in the US. I think that's going to be an interesting watch point for China in 2026, given the weakness of the labor market.
Yeah, fantastic. Well, thank you so much, Michael, for that thoughtful answer. Finally, a challenge question for our panelists. How do we know China is not just on a different path of growth? Why do we think it's the wrong direction? What if China is just undergoing a moment of adjustment and it will, come out fine and perhaps, turn out better than what we expect today? Um, what if tech investment and supporting household spending are not contradictory? What if we are just in this period of transition, this period of enduring the bitterness for China? What if China proves to be right? Anyone want to take up on that challenge? Arthur, I'm going to volunteer you, actually.
No, it's a good question. Um, and I think the way to think about how to answer that relates to defining what the objectives are, right? So if the um, uh, if the objective is for the economy to grow at pretty close to its maximum potential at all times, and thereby, you know, increase the growth in general welfare as consistently and fast as possible, the current path is clearly bad, right? Deflation of this type proves basically that the economy is growing more slowly than it could. So some economic growth is being left on the table. And it is very clear that the main people who are losing out from this is households, because their incomes are not growing as fast as they could under a different economic pathway. Um, so yeah, you could say, well, this is like a temporary transition, but first of all, there doesn't seem to be any change in the pattern. So we've now had essentially 3 years of this deflationary growth. The consensus around this table, and I think among many, many, many economists looking at China, is we're headed for a fourth that looks pretty much the same. And it's like, okay, when does this end, right? And then, so the government's answer to that would be basically, well, this will end because we'll make all these investments in this high tech stuff that will increase productivity and wealth. And if you read their policy documents over the last 10 years, that's basically what they believe, that technology investments will ultimately create this much more dynamic thing. And so there are two problems with that. One is they've been doing that now for 5 years and it hasn't happened. So how long do we have to wait before we think, well, maybe this isn't quite working out? Second, but just conceptually, the tech industrial sector is maybe what, 15% of the economy. It is not generating new jobs. In fact, it is decreasing jobs. If you look at job growth in manufacturing, it is negative. Industry has not net created a new job in China for the last 13 years. All new jobs in China have come from the service sector. And that continues to be the case despite the fact that you've had this gigantic manufacturing boom, huge increases in capacity. There are less people today working in manufacturing industry than there were 6 years ago, right? So then you get the question is like, what is the theory by which all of this investment in the technology side then spills over into the other 80 or 85% of the economy where everyone else is working? And I've never seen a satisfactory explanation of how that happens, right? Particularly because you have, unlike in the United States or Western economy, the United States particularly, you have a very deregulated economy where innovations in one sector can spill over very quickly into another unrelated sector because everything is just a kind of a free enterprise thing. In China, you have a very deregulated manufacturing sector and a highly regulated service sector where companies are under a lot of constraints about what they can do. So you look at the crackdown on the internet companies, they're told, well, you can't go into fintech, you can't go into online health, you can't go into online education. There are whole areas of innovation and exploitation of technology that the government had just said, you can't do that because it's inconvenient for us politically. So they have clearly blocked off many of the pathways by which innovation in hardware could spill over into the parts of the economy where most people live and work. But they want magically somehow to achieve those spillovers. I don't see how it happens. So yeah, I think we have to concede that China's track record is very good. The overall economy has continued to grow despite all these problems. I think it will continue to grow. There are a lot of good aspects to it. So it's not a catastrophic thing. But I think it is very clear that they are leaving a lot of growth, a lot of welfare gains, and frankly, a lot of technological development in the service sector. They're leaving that on the table and making it very, very hard for the economy to grow as fast and as equitably as it could.
Fantastic. Not a bad path, but perhaps not the optimal path. There are pivotal improvements, if you will, that the leadership can make. With that, a fantastic. What a treat. I want to thank you, Arthur, Michael, and Xiangwei for an exceptionally thoughtful and wide-ranging discussion. And thank you all in our audience for joining us today. For more analysis on China's economy and policy direction, I encourage you to follow the work of us here at Asia Society Policy Institute's Center for China Analysis. Thank you again, and hope to see you at a future CCA event.